wanted to thank everybody for hanging with us today. Hope you heard a lot of interesting stuff on the stage. Today we're going to talk with my friend Leif Abraham. Leif founded Public and Public.com, and you guys are, I think, becoming known as the ethical, exciting online brokerage. Is that a good way to phrase it?
Oh, I'd take that.
You'll take it. Okay. Leif, tell us a little bit about what Public is, how people use it, who are the investors on the platform.
Cool. So obviously a public investing app. We help people invest into stocks, crypto, and other alternative assets soon. The way we really look at the market is kind of these three kind of buckets. So number one, help people diversify into as many assets as possible, and basically be able to trade these things on the app. Number two, to kind of give them context around that. And so, we have a social community on the app where you can see what other people invest in. There's a lot of context, like, if a stock suddenly starts moving really quickly, you can kind of see why it makes those moves. And so, give people that context. And then number three, really kind of doing that with a business model that's aligned with those investors, right? And so,
how many users are on Public right now?
So the last official number we shared is 3 million. That's from earlier this year, and so
3 million. And when did you launch the product itself?
In September of 19. So pretty much exactly 3 years ago.
3 years, 3 million users.
Yeah.
A little round of applause.
Yeah.
Pretty good.
Yeah.
All right. So you mentioned the business model being aligned with the users. Tell us more.
So. First off, we are big believers in transparency, and I think we're big believers that if you build a great company that people respect, that you have also pricing leverage, and so you don't have to be afraid of things like fees. And so whenever startup founders are like, you have to make it free, everything has to be free, I honestly actually disagree with that, and that most people actually appreciate the transparency that comes with partially paying for a product. Now on the security side, so stocks and ETFs and so on, you know that in our business, a lot of the trading apps do this thing called payment for order flow, which is basically a way where you route orders to market makers and then kind of get a payment for that, hence called payment for order flow. And we decided not to participate in that. And that is one of the kind of ways of how we try to align with our members. Because at the end of the day, you want to build the best product for whoever your customer is, and so you want to build a product for whoever pays you, and that helps us to basically align our interests with them and make sure that.
How do the users pay you?
So it's different aspects, right? So crypto obviously has fees attached to it, and then we have on securities this thing called tipping, and so people have the option to pay for their order execution.
Okay, so in the eyes of the user, they control how much they're willing to pay per trade.
Exactly.
And they know that you're not routing these orders somewhere where they may not be getting the best execution.
Exactly.
Okay.
And by not participating in payment for order flow, we also have so far proven that we basically, provide on most trades the best order execution actually, because obviously there's no arbitrage happening anymore. So.
Okay. So when you think about the users on your platform now, how are they using it? What do you see them doing the most of?
So our user is really more the buy and hold, build portfolio user. So it's less the day trader type, which also comes with, we don't give people margin, no options trading, so it's very much like portfolio building, right? And so what we've seen really is that basically people DCA into the stocks and into the assets that they like, and they have much more had this habit of just every month adding to their portfolio and maybe buying it into an IPO here and there, but generally just kind of adding and trying to compound over time.
So in 2001, when there was a lot of controversy around he who shall not be named, and there was a lot of uproar over payment for order flow, and it became a political issue. What was your stance, or how did you guys get your message out that, hey, there's another really sleek, easy to use, fun brokerage app where we're not doing any of that stuff? Like that seems like it was a marketing challenge, and really how do you get heard amidst that uproar?
So we made that decision in January/beginning of February of last year. And so we, in the early days of the company, we had PFOF, and we're running on PFOF as well. And we kind of took it as it's the standard, just so to say, it comes out of the box. It's a clearing firm and so on. So of course you're just gonna take it. And then, especially during the time when all the GameStop, meme stock things happened, it just unveiled a lot around how especially retail, cares about transparency.
Yeah.
And we always talked about kind of going off PFOF and so on, and we also had this idea of tipping for a while, and then at that time, we basically put two and two together and and announced it through that. And so from like that perspective of like, we did it also in a moment of time where we had a lot of eyeballs on us, and so that obviously helped.
That's great. So what are you seeing in terms of the demographics of the people who are creating accounts on public and funding their accounts?
At this size, it's like all over, obviously, right? Average age is like 31, 32, that's all I can think about it. And obviously you have to be 18 in order to open a brokerage account. But really by now, it's like across all demographics, across all income classes and so on, right? So it's really quite wide.
How do you guys set the rules about what you will and won't let people on the platform do? Because there's a big debate about how much responsibility financial institutions and online brokers especially have when markets get very volatile or meme stocks become the thing that is attracting a lot of retail and a lot of unsophisticated money. You guys must have some sort of an internal discussion about where you think the line is, and your line is different than from where other brokerage firms are.
So first off, I think it starts with the products you offer, right? And who do you let into those products? And so there's a reason we haven't launched, for example, margin, just a fancy word for credit, let's be honest, and options and so on. The other piece is, of the things that we offer, we don't think it's our role to dictate what people can do or not do, but it's our role to help them to have more context. And so one example is, if you remember, I don't know when I was thinking it was in 2020 or so, right, when Hertz went nearly bankrupt and so on, and became kind of like one of the first meme stocks before it was called meme stocks, and so on. And like around that time, we came up with this concept of safety labels, for example, where once a stock or so becomes more volatile, it gets this little safety label, and if you want to buy it, you actually have to like slide to confirm that you understand the risks and things like that. And we do that on many cryptos, for example, as well. Okay,
so you're educating people while they're trading, and you're giving people the kinds of information that maybe they wouldn't get elsewhere. And I'm guessing what that ends up doing is stopping some trades going through. So that kind of works against your own financial interests. But it seems as though that you're willing to
exactly.
To do
I
that.
would, and like the way we think about it, like in this business, you basically have two sides of what you can do. You can either operate for high ARPU.
Yeah.
And so like, let's get as much money out of a user as quickly as possible, And so obviously, if you push people into options trading, like you will have a high ARPU, right? You will make a lot of money quickly. You also have a lot of people burn out, right?
ARPU,
Which means
ARPU is what?
Average revenue per user.
Okay, that's the
And
metric
so,
that most of your peers are judged on by Wall Street.
Generally, exactly.
Yeah.
And so, but that leads to high churn as well, right? So from a business model perspective, it's like you will always have to acquire more users, and you always have the balance of just bringing more people in because you're burning through a bunch of users, right?
Right.
What we think about it is we're optimizing more for lifetime, right? We want people to succeed in the markets, and as they succeed in the markets, we basically, rather have a model where we basically can collect fees at certain moments in times, connected to their success, and therefore, we're much more aligned in terms of people building their portfolios over time and not burning out, right? And I think especially if you're in the game of TAM expansion, like in the game of, welcoming a bunch of new people to the markets, I think that comes with a certain responsibility, because if the next generation of investors comes and immediately burns out, they will likely not come back. And that is not good for anyone. It's not good for the industry. It's not good for us as a business long term, and so on.
It's much more economical to keep a customer than have to always chase the next customer. Obviously,
1,000%.
We have a couple of questions from the audience, which we're gonna take throughout. Let's do the first one. Jonathan Novi wants to know: is your goal to grow as big as the largest custodians? If so, how are you going to get there? Do you think about the largest brokerage firms and custodians as where you want to go, or not necessarily?
No, I think about it more in that we are actively growing the market, and so I don't say I care about, but I don't think about how much can I get a slice of the business that is there. I care about how much can I grow the pie, and so I care much more about introducing more people to the markets, and growing with them, and also expanding into other markets in the future, et cetera, then I think about how much can we steal people from Schwab tomorrow.
Right. I mean, it would take a very long time to take enough money from Schwab that they would even notice. It's like a very different playing field, of course.
Yeah, 100%.
Okay, so you used the term expanding the TAM, and that's where I want to go next. I think the next generation of investors, they're interested in stocks. They have not been very interested in bonds. Obviously, why would they be? But one of the things that they seem to want to do a lot of is I don't know, next generation markets or maybe new asset classes that haven't historically been available on brokerage platforms.
Yeah.
So you made an acquisition recently that I know you want to talk about. Tell us about what you bought and what you plan to do with it.
Yeah, so we bought this company called Otis, which has been kind of like a pioneer in like alternative investing. And so alternative investing, when I talk about it, it really starts more with what most people would consider collectibles, art, rare comic books, high luxury items, et cetera, and really making those tradable and investable. And so ALTS is going to be the next category launching on public, and so we're integrating that as we speak. And really how we think about that TAM expansion is that many people will enter the markets through different asset classes. And I think crypto is a great example for that. We had a lot of people who entered the markets by investing in the crypto first, and then
did stocks
and then did stocks and other things afterwards because it was
Right.
their first exposure to it, right? And I think what is connected to that is like a little bit of, number one, just what is interesting, and therefore also what is to some extent culturally relevant for someone.
So do you have works of art on the platform now that have been fractionalized and can be traded? Is that what you think will be the next thing that gets this platform to expand the user base?
Yeah, exactly. And so, we're still moving things over from the old Otis, product right now, but generally speaking, you can think of it as like you can buy a share of a Banksy, for example. You can buy a share of, very limited edition Birkenbag, which for whatever reason, by the way, happens to be one, of the luxury assets that performs really well.
My wife said to buy the whole thing, not to buy the fraction.
Yeah, there you go.
I can't do that on your platform, unfortunately.
That's sad.
But one of the issues that comes along with art and collectibles and luxury goods is you guys have an added responsibility to handle the storage of these items.
Yeah.
And in some cases, they've got to be climate controlled. And in some cases, they need to be secured. So that's something I think that you can build that's very unique. None of the other brokerage firms are concerning themselves currently with storing items of value. Everything that they are allowing their customers to trade is digital, whether it's a stock certificate or a crypto or a token.
Yep.
So talk a little bit about what you think the challenge is going to be to make people feel comfortable that the items they're buying and selling actually exist.
So I think first off, it starts with we are basically like an exchange in that moment, right? So this is unique inventory to public, right? A buyer and a seller were both public users, and so that trade, gets matched within the platform. And so with that, we have first responsibility to create liquid markets, right? Because retail investors need liquid markets because they need to be able to trade in and out of things, more easily. Now with that, to create these liquid markets in the very first phase, it's basically a hack for us to take care of the actual physical assets because we have to create those markets in the first place, right? As the markets become more liquid, you can then go into, other partners. You might take this hotel and fractionalize it and take your fees on the actual IPO of it, but you might have a hard time, facilitating secondary trading, and that's, for example, something that could then happen within public.
You need there to be enough interest on the part of other people so that there becomes some liquidity.
Exactly, and so we are basically now we have to create the market, create liquid markets, and the trading that is there in order to open it up for more people to also sort of say take assets public on public.
So how do you do that? How do you I guess you buy a Banksy and announce that this is now available for people who want to bet on the upside. This is available for people who want to trade it or invest in it long term. How do you get the word out about each individual item that's going to be in the exchange?
Yeah. So first off, obviously, there's a whole sourcing team that does the sourcing and the the storage and the insurance and all that kind of stuff. then these things are actually registered with the SEC through a framework called Reg A+. So it's basically, think of them as like tiny public companies, and that makes them tradable with these shares in the first place.
Okay.
That is also just another layer of just, let's call it like validation, so to say, because it comes with the same investor protections that other securities come with, right? And so that is like number one. And then from there, obviously, it starts with the existing user base on public. But then every asset obviously can have also, an own story connected to it where you can tap into existing communities, right? So, Tony Hawk's an investor, for example, we're always talking about like, what if, Tony Hawk's skateboard becomes, I did the 900 with, becomes an actual asset. And, in that moment, you might tap into an audience, that follows that person already, things like that.
Is there a risk to this strategy that there will be too many collectibles and too many things available that none of them end up building a liquid market because of how fragmented the business is? Or will it be like stocks where the large caps have a bigger audience and a lot of people trading them, and then as you go down in, I guess, market cap, you'll have less liquidity?
Yeah, exactly. And like there are a few players in the markets who are, Otis was one of them, right, who are specialized on these alternative assets. And what often happens there is that they don't have the liquid market. And if you don't have the liquid market, they end up having to do these things called buyouts, where they're basically having some collector actually buy the whole thing, and then distributions happen and so on. But what happens out of that is that model becomes very much like just flipping IPOs. Right? It doesn't become an actual long-term investment thing, it just becomes this like flipping game, so to say. And so that's why we find it so important to create these liquid markets, right? But it's 100%, like there is a sense of, because we are also the exchange in that moment, like we are pretty concerned about like making sure that, that these assets, are liquid, have liquidity, and if not, like how to take care of it, potentially through buyouts and other things like that.
Do the investors have a say if there is a buyout, or an investor comes along and says, I'm actually going to buy the whole painting?
Yeah.
And you guys look at the price and you say, this is good for the investors. Do the investors vote, or do you sign up and just say, I understand that what might happen is this thing might get bought?
So in a best case scenario, there's never a buyout.
Okay.
Right? Like
The
goal is to have great assets that stay great assets over time, and they will keep trading, as long as they do, right? So that is obviously the hope, right? Comes back to the liquid markets. Like the buyout we really see as more of a, let's call it like a last resort, but it's more of like a mechanism you can use if an asset becomes stale, right? So if you see the line suddenly flattening out, right, then you have then you have that option. And in those moments, with some assets people will vote on it, and with some they might not.
We have a question from the audience. Is public forming the LLCs that own each individual piece of art, or purchasing shares from a Masterworks created LLC? What's the structure of each item that's going to be on the exchange?
Yeah, right now they're all their own LLCs, so to say. They're all their own mini companies, because we are bringing those public. No pun intended, but or maybe it is intended.
Pun intended.
But long story short, but in the future, like we do want other platforms and other even just potentially asset managers and stuff, like who potentially reg certain assets to then also bring them for secondary trading on public.
Okay. We have one more I wanted to get to. Do you want to work strictly with retail clients, or are you going to work with advisors? Because from my perspective, if you envision a world where 5 years from now, the typical portfolio is no longer 60% stocks, 40% bonds, but maybe it's something more like 50% stocks, 20% bonds, and then there's some sort of tokenized real estate, and then there's maybe crypto, and then there's maybe a slot for alternatives like collectibles, art, sports memorabilia, exotic automobiles. If that's what portfolios turn into on the retail side, you're going to have solutions for the financial advisor who wants to be able to create their version for wealth management clients.
So first, I think most investors do some active investing themselves somewhere as well, right? So in most cases, what we're seeing is that people do multiple things. Even people who are long-term investors might still participate in some meme stock here and there. Like people are not just this like one archetype. That's mostly what we're seeing, right? And so with that, right now, we're obviously an active investing platform, right? People pick their own stuff, they build their own portfolios and so on. But also how we think about public, it is a network. And so if you think of who are other participants in that network, advisors plug into that at some point.
Okay.
And so right now, for example, one of the other participants is public companies themselves. And so we launched this B2B product where public company CEOs can interact with real estate investors, can hold town halls, can kind of get the word out in different ways. And so that is, for example, one participant, right? Other participants are ETF issuers, And so it's just logical that at some point another participant will be advisors as well. And the way we think about it is that platforms like ours can make it possible for an advisor to not just have let's say a few hundred clients, but to potentially have 100,000 clients.
Well, one of the things that I think the advisor of today and tomorrow has to think about much more so than advisors in the past is differentiation. A lot of what financial advisors have historically done with portfolios on the asset management side has been commoditized in a good way. It's led to much lower costs, much lower prices, much greater trust, higher transparencies. So I think, though, that the question then becomes, well, if I'm offering a similar portfolio to the advisor down the street, and I don't have that close of a personal relationship with this prospective client, what else can I bring to the table that will be exciting and interesting to the client, but then also be grounded in some sort of investment philosophy where I don't look and feel silly for allocating toward it. Yeah. So I think that if that's the next generation, the next horizon that we're headed toward, it'll be very interesting to see who builds things for this space.
Yeah, and I think it's also quick little anecdote. A friend of Yannick's and mine is, he actually moved, a pretty sizable chunk of money from his managed portfolio into public. His advisor saw that and was like, whoa, why are you moving so much money out?
Yeah.
And then he ended up his advisor ended up making an account on public to follow him to see what kind of trades are you making, because you can post trades to public as well.
Yeah.
Right? And so on. So I think there's also just an interesting angle of, for an advisor to not just look at it as okay, what is the AUM that I manage, but also who are the people that I'm advising, and therefore having some sort of hand in advice in that, even that actively managed portfolio that someone has.
So is a B2B version somewhere on the roadmap, even if it's not imminent? But is there a version where there's an advisor product and it's just a question of what kind of access will the advisors want into their clients' accounts, et cetera? Do you guys talk about that?
Yeah. I mean, right now we're far away from that, but in theory, 100%. And again, it just falls back to we look at public as a network, and so as that network, there are different participants, and advisors is just a logical part of that as well. So
what percentage? We have a question here. How does public make money? So you mentioned tipping on trades and people that appreciate good execution and they're willing to recognize that. Yep. How do they do that? Is it on the trade screen? They can say, I'm giving public X dollars. Yep. This is what I'd love to know. What percentage of users regularly opt in to? Because I got to tell you quickly, this new thing where every time I want a chocolate chip muffin, I got to give somebody a 20% tip. I'm not feeling it. So that's they flip that screen around to me. I flip it right back. So here's my. So how do you get people to play that game and recognize your service and pay?
So first
that was 5 questions.
Yeah. So first off, there's 3 aspects, right? So think of monetization as assets, transactions, and software.
Okay.
And so assets, right? Cash on, interest on cash.
Yep.
Sec lending on, on securities which are invested, right? Then transactions, spreads on crypto, fees on alternative trades soon, tipping on securities, as well as things like instant transfers, taking money out instantly to your debit card, things like that. And so very straightforward. And then software, which falls into subscription offerings. So we're in the middle of rolling out public premium right now, for a subscription offering that we're launching, and so on. So those are just high level, just the 3 main components of that you can think about.
Which is fairly traditional, right? That's okay. And then the tipping part.
And then the tipping part. So we have not published any conversion rates there, and likely we won't. But let's say that it's more than you would think.
Okay. All right. I will. I mean, I guess we'll accept that. Guys, give it up for my friend Leif. There are not that many people building things with the right intentions for the end investor. and making that central to the business model. Leif is one of those guys, so we really appreciate you coming today. Thank you so much for doing this. Awesome. Thank you. Thank you.